Good morning, ARMR Insiders. Welcome to the morning meeting, the morning call. It's September 20th. It's the Monday of Fed week, and we got a market that's nosediving. So let me start by saying, as I was saying, risk monitor red, right? So this is, I think we went risk monitor red 2 weeks ago. This will be the second week. So by the end of last week, the market was lower than when we went risk monitor red. And while the indexes were going a little bit lower, we saw still a couple of highly aggressive growth stocks popping off to the upside. But underneath that smoke screen of normalcy, as if the market's doing okay because some stocks are going up, we continued to see serious deterioration. It's why going into this weekend, I'm carrying 85% cash or more in all my portfolios, okay? Something over 90% in my most conservative portfolios. We dipped our toe in the water last week, at least I did. The ARMR Report did, right? This is a guide. I'm sharing with you what I do personally, what I do for clients whom I manage money for, right? So that's really what I talk to you about. You have to figure out your own risk tolerance, your own goals, all those things, okay? So I'm just sharing with you how I do this. Sometimes I hesitate to share how bearish I am or bullish I am because I really need you to make your own decisions, right? So I try to give you an even approach to what's going on. I let you know what's happening. We talk about the risk monitor. It's been red for a while. I dip my toe in the water, putting index positions into the portfolio because I had too much cash, I thought. And the very next day gets stopped out. That is a clear indication that we're risk monitor red. When you're risk monitor red, you don't get stopped like that. It's particularly not on indexes because you're in a grind higher market. So when these things start to happen, they're just further confirmation of what the algorithms already know, which is that the market's risk monitor red. What the algorithms don't know is how far down the market will go. And the reason I respond so aggressively when I get risk monitor red is that by definition, before any major decline, we get risk monitor red, right? By definition, it gets risk monitor red, then it collapses, okay? There'll be a number of times where it's risk monitor red. The market only goes down 2-3%, reverses, starts going back up again. I end up putting capital back out. But my job, I feel very often, it's not always fun to do what I do, right? Many times I feel like the only adult in the room. And it's not fun being the only adult in the room. It's a lot more fun to play. But this is my career. It's my personal capital. I'm a fiduciary for others. And so it definitely tempers my enthusiasm and puts the top of my mind protecting capital. So I come into today with a massive cash position and the market's dropping fairly aggressively. I don't know how far down it's going to go. So let's talk about how we're going to play this and why I think this is happening and what the black swans are, because that's really what's important. I'll probably by the end of the day be stopped out of almost everything in the portfolio. What do we have left? I don't know. Maybe not. Maybe Microsoft and Amazon, hold on. Gilead and Pfizer, maybe they stay above stops. We have some XLU in there. When the market starts going down, everything goes down with it. So it's generally by the time the sell-off is over, everything has blown through a stop. So I don't wait too long. But I also don't bang everything out Monday morning. You guys know how I feel about Monday morning gap downs. That's actually my favorite type of market. So I don't know if this is just the final implosion right in front of the Fed meeting, and then by the end of the week, the whole market has reset itself and we're putting a lot of money to work. We may be doing that. So we can't get overly negative. We'll follow the stops with the rest of the positions. But let's be honest, at least the portfolios that I'm managing, I've got massive amounts of cash. So the last couple positions, it's not going to have a major impact on the portfolio one way or the other. So I'll just manage them to their stops. There is a gamma magnet at 4,000 on the S&P. So if somebody wanted to twist my arm and ask for a price target of where the market should stop, I would say 4,000 on the S&P and 400 on SPY, which is something, I don't know, what are we at? We're at 434 right now on the SPY. Okay. So that would be the first major area of support. Now, I hate to come up with support areas because it does not mean that I start buying the market or buying stocks because 4,000's hit. The market could crash through 4,000 and then reverse back up to it. Like just because I throw out a number doesn't mean that's where we start doing something. It's just there's a number to look at. When it gets there, it should behave differently. If it doesn't, the market's even in worse shape than we think. If it does, we recognize that, we put capital to work because we get a risk on green signal right around that number. That would be almost too ideal. Usually what's the, best laid plans in war, in battle, like they go right out the window the minute the bullets start flying. So, and typically big round numbers, everybody sees what I see. What I'm sharing with you is not something, secret. So it'll hit that price, who knows, crater below it. And then we look for reversals, or maybe it never gets to that price and levitates above it. So we don't have to have an exact 4,000 touch. But when we get down there, we start looking for triggers and looking for behavior that would get more bullish. I don't think this has anything to do with the Fed. I could be wrong. We went over this on Saturday's video. For anybody who missed Saturday's morning meeting, let's go over this, or weekend review. Let's go over this together right now. What I highlighted on Saturday was a progression of charts. First of all, we see risk monitor red was right here. The market was down all week. Now it's going to crater. And this is a definitive breakdown from the uptrend that we've been in for a very long time. Right? This is a definitive breakdown. There's no way around it. It's 1.6% down. It's going to open up 434. So somewhere around there, somewhere around right here, the market's going to open. So unless there's some unreal recovery where the market closes up on the day, which is possible. It's a crazy market. It's possible. But if it doesn't do that, you're getting a gap down below the uptrend, below the 50-day moving average, with a major magnet of 400 down here and the 200-day moving average down here. So, barring some massive reversal, the uptrend is done. And what we talked about on Saturday was a progression of these charts. So partially the market is anticipating the taper in a more aggressive way than I think. People were very complacent about it, and it's starting to get not complacent. So treasuries tried to break out. They failed. That means rates are going up, right? XLU. We cut out Duke. We cut out Southern Company. I stayed with a position in XLU. I was going to do it for one more day. I wanted to see how this thing behaves when the market starts going down. It should start collecting buyers as a place to hide. If it doesn't, we have a serious problem in the market. Usually utilities hold up or go up when the market is going down, unless you're in a pandemic and everything's crashing, or, a financial crisis or something horrific, and then everything goes down. So I'm giving this another day. The 200-day moving average was always in the back of my mind as my stop on this ETF, and I want to try to collect the dividend if I can. But what that's telling you, along with treasuries, is that interest rates are going up. And then we looked at the dollar, and the dollar was breaking out after making a huge base over the last 6 months or longer, actually, over the last year. So currency markets are anticipating a taper and a stronger dollar. And of course, we all know, and we avoided this pothole, but gold imploded last week. Gold stocks really, really took it in the neck, right? As they broke below. And of course, silver just, fell off the map, right? So these chart patterns are all busted. And so what that tells you is the Fed is definitely going to taper, definitely going to do things that will raise interest rates. Not that they're going to raise rates, but they just, I think what people don't understand about this, about the market, it's a mechanical bull created by the Fed who has pumped in ridiculous amounts of capital. On top of that, we're getting stimulus checks, constantly. At some point, this is the thing people don't, I've been reading a lot over the weekend and a lot of commentary and a lot of expectations of Fed and taper and all this stuff. But what I think people don't understand is even if the Fed were to just keep liquidity even at this point, the markets go down. There's nothing left to put the market up. And I don't buy the story that stock buybacks put the market up. I don't follow that argument at all. To be quite frank with you, I just don't follow that argument at all. Okay. If the Fed, now, if you want to tell me that stock buybacks will juice the market, in other words, the Fed keeps adding liquidity and then stock buybacks on top of that, okay, great, that'll juice the market. But if the Fed stops adding liquidity, that is a big hole to fill. And I'm not even talking about the Fed tapering. I'm just saying the Fed flatlines liquidity. When the Fed flatlines liquidity, I don't have the chart for you right now. Maybe I can find it. Maybe one of you guys can find it. It's out there. It's pretty clear. When the Fed flatlines liquidity, the market comes down. It's not even that the Fed has to add. The Fed's got to keep adding liquidity for the market to keep going up. They don't have to reduce liquidity for the market to go down. They just flatline. And there's no fuel. So you say, well, buybacks will fill in that fuel? No way. Not in my opinion. I could be wrong, but I don't buy that for a second. That'll just keep things steady at the best. At best, they'll just keep things steady. Maybe stock buybacks help the market from crashing. There'll be a cushion. Someone will be out there buying back stock. Great. But driving the market to all-time new highs? No way. No way. Okay. So we have to read and react to what we're given. So the market's selling off today into the Fed meeting. Fed's going to say whatever it is they say. Maybe it sounds like I'm very bearish right now, but I'm not married to a direction in the market. Okay. If we get to the Fed meeting and the Fed says a bunch of things everyone expects, and the reaction to the news is bullish, that changes the risk monitor green, I'll put money to work, because the reaction to the news is all I care about. It's not looking at tea leaves trying to figure out what the news is. I really don't care. If the Fed came out and said we're not reducing liquidity and the market went down, would you argue that the market should go up because the Fed's not reducing liquidity? I hope you wouldn't. I hope you would react to what's happening, which is the Fed said they're going to keep adding liquidity. The market's going down anyway. What's wrong with the market? Something's wrong. You see what I'm saying? So I'm going to react to the news. I'm going to look at the reaction to the news and make my decisions. And that's what the algorithms are for. That's why the ARMR investing way is about using algorithms to help us add risk or take risk off. So we can get rid of all the noise and get rid of all the postulating and get rid of all the coming up with scenarios and watching CNBC and wasting our time because nobody knows anything and everyone comes up with an opinion and there's 10 different opinions for one direction. Okay. All we care about is what's the reaction to the news, and algorithms are the clearest expression of the reaction to the news. They don't care about any of the fundamental story of what may be blah, 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 blah. They just show you money flows and liquidity flows, and that's it. So we get to the Fed meeting. I don't care what they say. I want to see what the reaction to the news is. If we get risk monitor green, we put money back to work. That's why we spend the next couple of days continuing to refine our whiteboard. What do we want to own? Hey, guess what? We're going to get a shot at uranium stocks. If you want them, they're coming down. We're going to get a shot at crypto stocks, cryptocurrencies. They're getting crushed. Everything gets ripped down in a market like this. And what you look for is to see which positions that are on your whiteboard behave the best. The cream will rise to the top. When we get a risk on buy signal, those are the names we hit. Now I'm going to wrap up this conversation, get to the live trading desk, because today, from a day trading standpoint, as it has been for the last week or two, for me, it's just pure index trading. When I have this type of volatility in indexes, I don't need to try to figure out what stock might have a gamma squeeze. Not to mention the fact that, 7 out of 10 stocks follow the market, probably 8 out of 10 follow the market, maybe 9 out of 10, on an intraday basis. And so I don't care how great the setup may be in a gamma squeeze idea. If the market's plummeting, the probabilities of making money versus how many losses you have to take isn't worth it. So for me, there could be 2 or 3 trades today. Probably long will be the first trade. The market plummet at the open and set up a reversal. And I'm going to hop on that reversal, see if I can make money in the indexes, right? If it ends up being an unreal reversal, I just captured alpha. So the alpha capture trade is my favorite thing to do. When I have massive cash in the portfolio and the market plummets at the open, I'm just searching for where can I put some money into the S&P and the NASDAQ 100. Those are my favorite, maybe just the S&P. I just love those trades. Then if the market rips higher all day, I've just captured unbelievable alpha. And if the market goes down and I take a small loss, so what? The market's getting crushed. I took a small loss. Okay. And I set it up. I set the same trade up again. I might try that trade 3 times in a day. And I might lose money twice and catch the third trade and make a fortune as the market rips higher all afternoon. So that is my singular focus. I'm not looking to buy puts. I'm not looking to get short. Okay, I want to take advantage of the weakness and get long the market. Big picture it. If we do that every day, one of these days in here, we get a day trade on and the market rockets to be up on the day at the end of the day. That turns into a swing trade for me in some portfolios. I say, thank you very much. I just picked off the bottom market at the lows and I swing trade it using the low of that day as my stop. Okay, so these days, I just love trading indexes. There could be 3 trades today. Crater, risk, we get an entry point, it rips higher, sets up a top over an hour or 2, can't get above VWAP, book our profit, get short, own puts, the thing implodes into the close. That would be 2 trades. But sometimes in a real bear market or correction, you'll get 3 trades. The rip higher in the morning, the sell off in the afternoon, and then we get another trade in the last 45 minutes of the trading session, back up to VWAP. Sometimes it happens like that. So that's where my focus is, day trading. I want to round out this conversation by saying to you guys, I have been beating the drum for a while now of how dangerous Chinese stocks are. Now I'm starting to be concerned that I don't even realize the depth of the danger that the Chinese government is causing in Western equity markets. I'm just germinating this thought and I'm sharing it with you guys, my ARMR insiders. I haven't, gone out there and pounded the table on, a YouTube video or something, but I'm just sharing it with you as I'm, germinating this thought. But there is I feel a process underway in China to destabilize Western financial markets. And it starts by stealing money from investors here in the U.S. They let a company go public here in the U.S. and then a week later tell the world that what the company's doing is illegal and they can't do it, and the stock craters. They just stole money from the West. They're probably laughing about it, okay? And then what they do is they totally trash a sector, which was the schools, right? Online schooling. Used to be a great sector. A lot of people made a lot of money in those stocks. And within a month or 2, they're down 70, 80% because the government of China decided they should be not for profit. I mean, how do you invest in a country where the government just arbitrarily comes out and decides a legitimate business can no longer make any money it has to be not for profit. You got to be out of your mind to buy Chinese stocks. Out of your mind. From a risk reward standpoint, I don't know how anybody does it. You go to bed every night and the CCP has another rule when you wake up in the morning. I mean, I think I'm preaching to the choir here. You all agree with this. You all get what I'm saying. But let's just follow these breadcrumbs, if you will, right? So first, it's a high-profile IPO that is a stick in the eye of Western investors, and it's within 5 days of coming public. Then it's a complete trashing of an index of an industry that was for profit. All of a sudden, overnight, it's not for profit. Now, what is concerning me? People have been talking about the real estate bubble that's gone on in China for a long time. Okay, it's been out there for a long time, and let me tell you something. There have been short sellers that have been carried off the trading floor in a body bag trying to short what they kept saying over and over again is a phantom market. It's a fake market. Pictures from China. People would send you, if you remember this, photographs of ghost towns in China. Like they pretended it's real estate and they build these towns and nobody lives in them. It's just like a wasteland. And they have these companies, these real estate companies, right, that have ridiculous valuations. Well, now one of those companies is going bankrupt and it's going to be in receivership. And I think that the expectation is that the Chinese government's going to bail them out. And I would just like to say, hold on a second. The Chinese government's nothing like a Western government. They've been proving over the last 12 months that they have no respect for Western capital markets. Way back at the beginning of all this, they refused to follow generally accepted accounting principles for all of their companies. They just said to you, screw you. If you want to invest in us, we're going to make fake numbers and you have to accept it. I mean, come on, that's what they said. The rest of the world follows generally accepted accounting principles. China doesn't. They follow whatever accounting principles they want. This has been building for some time now. Now they have one of their largest property, real estate companies going bankrupt. And all that I read over the weekend is the Chinese government's going to bail them out. Why is that? The Chinese government might take the management team and send them to a rehabilitation camp. They might do that. But to think that they're going to make investors whole, why? Why do they care about investors? I'm just throwing that out there, guys. To me, that's the black swan. And it'll have a ripple effect. And a lot of smart people are saying it's not a big deal. And I'm not convinced. I'm not convinced. I'll believe it when I see it. So I only bring this up right now because if we see the Fed make some fairly benign comments on Wednesday that everybody expects and the market plummets anyway, I suggest to you it's not really the Fed that the market's worried about. There's an unravel going on that I think will have something to do with China. Now, I'm in the weeds right now, and I appreciate you guys joining me in the weeds this morning, but this was what was on my mind, and I wanted to share it with you. Let's all have a great trading day. We should be fairly even keel. We should have a portfolio that's protected. The market cratering at the open is not a big deal to us, and quite frankly, it should be an opportunity for us. So I'm coming into today looking for opportunities to get long the market. For day trades, possibly they turn into swing trades. Could happen as soon as today, or the market has to go all the way down to 4,000. I don't know. Let's be nimble, head on a swivel, protect your capital first, capture upside second. I'll see you guys for the in-game update. Let's have a good day trading. All right. And any questions here? I think something just popped up. Exactly. Carl says, right. People were saying COVID's not going to be a big deal last January, and that turned out to be a massive pandemic. Right. Exactly. That's right. That's right. And I always, I just don't, I don't think the market's going to go down dramatically because of what the Fed does. It's never what you see. It's never what everybody knows and everyone's talking about. If everybody knows it and everyone's talking about it, that's not going to derail anything. It's something out of left field no one's paying attention to. And I don't see a lot of people paying attention to or concerned about what's going on in China, but it's been concerning me for months. The behavior of the Chinese government. It's very anti-Western establishment. And I wouldn't put it past them. And now I'm totally in the weeds, so forgive me. But I wouldn't put it past them to let this big real estate company get buried because they know Western companies, managers, money managers, whomever are attached to it, that are going to go bust. And that's fine with them. They'll bail out their own buddies in some other way. I'm just saying, maybe I'm crazy right now. I don't know. Let's get back to reality. Let's just try to make some money in the market today. Don't shoot till you see the whites of their eyes. Be patient. And guess what? It's okay if you miss a rally. It's okay. It's okay. You don't have to jump on everything. You don't have to trade today. You could just sit back and say, hey, I got a nice cash position. I can handle this and wait for the next risk on green signal. There's nothing wrong with that. That's what the whole ARMR algorithms are for. It's not to make you feel crazy like you have to trade every day. I trade every day because I find it, I enjoy it. But for the investor, there's nothing to do today. Get off the desk. Go to the beach, play around the golf, go have some fun. You don't have to trade today. Risk monitor is not going to turn green today, and it's red, and you should be protected. So now's the time to take a deep breath and relax because we're prepared. Okay? See you all on the flip side. Have a great day trading.